how would you navigate, the current market and investing in a crisis? And what, if anything, do you think has changed, and where do we go from here?
Well, the way you navigate the way you navigate the market in general is you always have to look at what's going on at that moment in time. And moment in time doesn't necessarily mean today. It could mean the moment in time of in the month, in the year, what's going on in the world, okay? Markets move on information or lack of information, uncertainty. When there's uncertainty in the markets, generally the markets will go down because they have no direction. They're reverse, the market is, we don't know what's going to happen. For example, and this is, please, by no means political, when President Trump was diagnosed with COVID, what happened to the markets? They went down. Yeah. They gained, they cut their losses, but they were huge jitters that if he died, it would cause economic upheaval and turmoil in the world, and not economic upheaval in the world, but it would cause problems. It would be a negative effect on the markets. So the market starts selling off. When he was diagnosed, when he was, everything's okay and information starts coming out, the markets stabilized and moved back up. The stimulus, they announced that the stimulus package, they're not going to pass it. And the markets went down on Monday. On Tuesday, the market went up for another reason. So you navigate, the markets, the one constant about the market, it will always move up or down, and the volatility can be, really huge, or it can be just normal market volatility. Right. And it all depends on the current situation, what's happening at that moment in time. There's always opportunities for making money in the market, whether the market is going down or it's going up. Mm-hmm. The bulls and the bears. Here's a nice saying that you may or may not be familiar with on Wall Street. Bulls make money, bears make money, pigs get slaughtered. Yep. Okay? And greed are the pigs, right? That's, but it's an old Wall Street saying, and it's been around forever. Mm-hmm. But when the market is going down, people that are selling short the market, and I'm not sure if you're familiar with what that means, is they're selling stock that they don't own. They're borrowing. Right. Okay. And then they have to replace the stock. So they sell the stock at $100 a share, hoping that it goes down to 50, and then buy it back at 50 and replace it. They pay interest on borrowing that stock. They pay a cost for borrowing that stock. But at the same time, they sold it at 100. They bought it back at 50. So that's what happens and there are rules and regulations for when you can sell short. That's just an example of how people make money when the market's going down. But what has changed with the markets? The only thing that ever changes is world and economic events. That's the only thing. But the constant in the market is how it reacts to all these different economic and world events. Like now we're going through COVID. Mm-hmm. We went through the financial crisis of 2008, 2009, World War II, the Korean War. All these major things that happen around the world are what makes the market move. So what's different? Nothing. It's the only major difference is the speed of information. Let's say 1900, okay, the year 1900. The only way to get information at that point was, I think we had the trains, if not by Pony Express. So some person knew information about an economic policy that was going to, the president was going to raise taxes and it was going to hurt the economy. And who knew at that point? Just a handful of people. Right. How fast did it travel from Washington, D.C. to, all across the United States? It took forever. Mm-hmm. Okay. And the markets, whatever the market was back then, reacted to the information as it received it. Mm-hmm. Today, you sneeze and the world knows instantaneously. Right. So that is really the major difference in the
Yeah.
markets. It's the speed of information. And that leads to something called the efficient markets theory, something I learned in college. I don't even know if they teach it in college these days anymore, if you're taking finance courses. But the efficient markets theory is basically the world, the investing public, has a piece of information all at the same time. Everyone has the same information all at the same time.
Right.
So everyone reacts swiftly to that piece of information. There is no, a group of insiders that know the information and then 3 days later someone else knows it.
Right.
So technology is what has caused the markets to react the way they do, because now, again, some information comes out, everyone knows it simultaneously, and that's where you see the insane volatility at times.
Yeah.
It spikes up or down.
It's all right here, and then we get lots of impulsivity, and I'm guilty of it too. You make irrational decisions.
Exactly. So that's what's changed. Again, don't look at any specific event as being any different than any other event. It's different where we have this pandemic, right?
Mm-hmm.
But we've had pandemics before, 2009, one. But again, every month or every day, there's something new that comes out. And all it does, when you look at it from an investor point of view, is it a negative impact or is it a positive impact to the markets? And how are you going to react to it?
Right.
So it doesn't matter what happens. Something's going to happen. The markets are going to react. How are you going to react?
Mm-hmm.
That's it.
So I came back to what you said about the efficient market hypothesis. I know, there's the camp that says today that, due to that, like value investing and Warren Buffett's whole approach, and Ben Graham and all those guys, they say value investing is dead because the whole way that they invested was, they were finding things that everyone didn't know, like undervalued assets and things of that nature. So do you think that, what's your stance on value investing? Can you still find value in that regard, or is it just more so, all based on future things that people aren't considering?
Well, one of the key advantages. Well, first of all, yes, I do believe that there is value investing still exists,
mm-hmm.
And we'll go through a couple of examples probably in your next section. But value investing still exists. But the key benefits of someone like a Warren Buffett, or an investment professional that works for an analyst that works for Goldman Sachs or one of those companies is, they get to go and speak to the CEOs of those companies firsthand.
Mm-hmm.
They get access to a lot of other information firsthand. Now, the general public has access to that. A lot of especially today, when a company, like IBM reports its earnings, they provide an earnings report, and on the news you'll just see headlines, right? But
mm-hmm.
you go on IBM's website,
it's all there.
There'll be a link to the detailed earnings for IBM. Okay. From there is where a person like Ben Graham and Warren Buffett have their computers. Today it's computerized. Back then it was by hand, mm-hmm. where they looked at the company's performance and determined this company. They did a huge analysis on the company and said, you know what, we believe based on our analysis that this company is really worth $100 a share. It's currently trading at $50 a share. It's undervalued. We're going to buy it.
Right.
Well, the reverse. We believe it's worth 100. It's trading at 150. We're not touching it. We don't think it's worth $150 a share. There's a lot of metrics that are publicly available today. When you pull up a quote on, Yahoo Finance or whatever financial online thing you're looking at, where you'll see different ratios. There's something called a price to book ratio. What's the book value of the company? So if you took the company apart and sold it off in pieces, how much are you going to get for the company? That's the book value. Okay. I mentioned price to earnings. There's other key ratios and indicators that are easily available that people can say, well, you know what? I don't, for me, I don't, you know, they don't have to be financial geniuses. They can, you know, compare the company to the industry. They compare the company to another competitor and see, okay, what's the true value of this company? And there are a lot of ratios out there that give you a good indicator. So you can make your own decision and say, all right, I'm willing to pay a little extra, even though I know it's overvalued.
Right.
I'm willing to pay a little extra. No, this company is way overvalued. I'm not going to touch it. And just so for your viewers, a stock that's trading at a penny a share can be highly overvalued. Just, you know, people should not make the mistake of thinking that if a stock like Google is trading at 2,000 and change a share, and a stock that's trading at a penny a share, that stock at a penny a share can be 100 times more overvalued than Google.
Right.
Because that penny a share stock, you know, could have absolutely zero earnings, could have absolutely zero cash. You're paying a penny a share for it. For what? You might as well take a penny and play kickball with it or something. And,
right. And I think that's a problem. You know, it all relates, you know, to the how all the information is instantly accessible, and you know, like you said, but people don't realize that, and they see Google, a great company, at, you know, let's say 2,000 a share, and they say, oh, I'm not going to buy that. But then, you know, they'll put $10,000 into a penny stock, and whether you have 5 shares of Google or 10,000, you know, penny shares of a penny stock, and it goes bankrupt or it goes to zero, you still end up with $0.
That's right. So
you brought up IBM before. I just did a video on them earlier. What do you think of the decision to spin off the company?
I think it's good for investors. It unlocks value because in a spinoff of a company as sizable as IBM, I mean AT&T is probably the best example. People that owned AT&T since the 60s probably didn't make too much money. The 70s, I don't remember. The 70s. Probably didn't make too much money on the actual share price of AT&T, but they made a killing on all of the other companies that AT&T spun off. So if you owned AT&T, you know, at one point, if you own the original AT&T shares, at one, you know, and it spun off all of the other phone companies, which today are called Verizon and Singular and AT&T Wireless and Lucent Technologies and all. You received, as an AT&T shareholder, you received shares of each one of those companies that on their own either performed very well or, you know, didn't perform as well. But so for the most part, when a company like IBM spins off a division or a unit or a wholly owned subsidiary, it's usually a good thing. It unlocks value for the company. It's a way of, it's another way of streamlining the company's assets and streamlining the company's operating costs and units, so they could focus and concentrate on what their goals are, and let that unit run on its own. Okay, and let it be its own self-sustaining company. So it's generally a good thing.
Yeah. IBM, you know, I own a small position, and you know, I've been considering getting rid of it up until the announcement came, and then I was like, all right, I'll look into this. And you know, after I did the research, I feel good about it too. You know, I think new CEO, Arvind Krishna, I think, you know, the future, you know, it's definitely an underdog story. I mean, they're way behind still the likes of, you know, Amazon, Google, Microsoft, etc. But I like the underdog story, so I think I'm going to hang on to them. With AT&T, yeah, I know I have you know, family and friends who have owned AT&T forever, and then they got and Comcast spun off out of it. That went on to do very well. Um, so regarding, I guess we kind of touched on this for asset allocation. Are any sectors more appealing to you now than others? And, you know, in the short, medium term or long term, like, what do you think? Should investors be staying away from any industries?
Okay. Well, let's first, I want to clarify something with you. You're talking about asset allocation versus sector allocation. So an asset class, for example, stocks is an asset class. Real estate is another asset class. Insurance is another asset class. Okay, so when we talk about asset allocation, and then you have, and then you have the large company stock, small company stock. That's again asset allocation. Okay, sector allocation, which is what I think you're kind of asking about, because in your question you're saying, what sectors or what industries. Okay, that's more of a sector allocation. So I want to make sure we define that clearly. So as far as different investment sectors right now, I'm focusing on many different ones, and I like quite a bit of them. So financials, I like some of the financials, not insurance, mostly, some banks. I like some banks. Airlines, I like airlines, and travel, cruise. Consumer goods and technology is what I'm focusing on right now. And like you said before, you like the underdog. Well, so do I. How much risk are you willing to take? Okay. So I looked at, these industries that got hammered by this disastrous disease and pandemic. And then I look at individual companies and I say, yes, we're going through a very rough time. And I start thinking not only about the company, about the company's performance, its balance sheet. How long is it going to be able to sustain operational business without any revenue? Okay, what's management been doing? Then I look at what is the government doing to support these industries, and I say to myself, I don't think that the U.S. government is going to allow the airline industry to collapse.
Right.
I don't think that the U.S. government is going to allow the banking industry to collapse.
Mm-hmm.
How's the banking industry at risk? I hope people realize this. If you have 30 million people out of work, and they have credit card payments and loans, where do you think the people are going to spend their money first?
Right.
They're going to look to put the food on the table. That credit card payment is getting pushed aside.
Mm-hmm.
Right? That's how banks and financials are going to get impacted.
Mm-hmm.
So I like them because I'm looking at good, solid companies, strong companies, and I'm willing to take a risk on these, especially at the prices that they went. Some of them went down so low, and some of them are back to being, at March prices, when in March 19th or 20th was like the low point in the market before the rebound started. Some of those stocks, some of the airline stocks are back down to those levels. Some of the oil stocks are back down to those levels. So I looked at it as, before we said value investing, I believe that there still is value in a lot of sectors, especially the airlines, the cruise line, and the travel industry. But there's a huge risk.
Right.
If the risk is how long, if the country stays locked down, and not just the United States, but other major European countries, Australia, the longer a country stays shut down, not only is it impacting their own country's economy, but it's impacting world economies, because there's no trade, there's no travel, there's no tourism, everyone gets affected. So how long are we going to stay shut down? And you watch and you follow and you make a judgment call. I made my judgment calls, and these are the sectors the sectors that I like. As far as the asset classes, I pretty much stay with large cap stocks, with large company stocks, and not for any particular reason. These are just the ones that attracted me the most at this moment in time, because I like all asset classes, small cap stocks, medium, mid-sized companies, and there's so many investment products. I still look at real estate. Not that I do much in real estate, but I follow real estate to see what the trend is, because real estate activity is also a good indicator of economic performance. Right. The more housing sales there are, the more people are going to buy furniture and paint and fixing up. And so things like that. And even insurance products, things called tax-deferred annuities are one of my favorite asset class, one of my favorite investments. I like them better than bonds. Mm-hmm. There's things out there called equity indexed annuities. They're insurance products. And in plain, simple layman's term, they are a bank CD with an insurance company, and they pay you interest based on the performance of either a stock market index or a private index, like the Schiller index or Barclays Trailblazer index. Mm-hmm. But there's a lot of information that needs to be discussed about that. But it's another great tool that I use, especially for retirement money, because it's a long-term investment. Right. So, though, as far as the asset classes, again, it all depends on what's going on in the economy at any given moment in time. Mm-hmm. And you take a look at them, and the most important thing I want to stress is you determine an asset class, you determine a portfolio after you have a detailed conversation and analysis about that specific person's financial situation and personal situation, their risk tolerance, their goals, their dreams, their savings, their earnings. What are they doing? All of this. And that's when you take all asset classes into consideration. A good financial planner is going to look at that individual's detailed life, financial life, analyze their preferences, their risk, their this, everything about them, and look at all available investments out there based on that, and say, okay, based on everything we discussed, I am recommending this portfolio that includes individual stock, that includes bonds, that includes an insurance company's annuity, that includes real estate. And I suggest we use these asset classes and we invest in these different sectors. And this is the projection. And we can draw income at a certain point, all of these things. So you take a look at all available asset classes, investments, and you create something specific for that person.